Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren.
Hey everybody.
Hey Lauren, our last episode we talked a little bit about integrating the wealth and the taxes, and today we're going to kind of continue that theme, especially we're in the heart of the tax season.
Right.
So what did you come up with on that?
Well, one of my clients sent me a very interesting chart from the New York Times, and it was a really complicated chart, but I wanted to just pick out one little thing from the chart. What this chart shows is one of my favorite topics, which is the difference between what real investors in the real world could have made, as opposed to something that would have happened in a very stylized sense. So the particular time period I want to look at is the time period starting in 1967 or 1961. And what this chart showed is it showed the effect of investing in the U.S. stock market, but subtracting inflation, subtracting average taxes that people would have paid, and then subtracting the average expenses that people would have paid.
Okay.
Now in 1961, there were no 401k plans.
Right. You
had to pay taxes on your investments. In 1961, there were no low-cost index funds.
Right.
There was no globally diversified portfolios. Well, what we do for our investors, for an individual investor, you couldn't have done it in 1961. Investing in international small cap, investing in emerging markets small cap, even investing in U.S. microcaps, to have a diversified portfolio of this stuff, even if you were very, very wealthy in 1961, you couldn't have done it. You had much, much more limited options.
If I recall correctly, the 1960s, the tax rates were also much higher.
Yes, exactly. So that made things even worse. So, from 1961, for 20 years, if you invested in the U.S. stock market, but you paid average taxes, and you had the average expenses of mutual funds that existed in that time period, for 20 years, you would have lost money.
So even inflation. Though initially at the top it may have looked like a positive return,
yes,
by the time you take the taxes and the inflation out, you're in a losing position.
Yes,
okay.
You're losing money.
All right.
And I wanted to bring this up because I can't prove how our strategies would have done in 1961 because, well, they didn't exist at that time.
They weren't available.
Right. But what I can say is that, and we often mention this in our presentations, what I can say is that the last 10 years of the stock market, from 2000 through the end of 2009, that was the worst decade ever in the history of the U.S. stock market. And even if you invested in the tax-efficient, low-cost, passively managed S&P 500 index from Vanguard, you still would have lost about 1% per year during that time period.
Right.
During that same time period, our most aggressive 95% stock diversified portfolio made about 5% a year, actually a little bit more than that, and this was after all fees and all expenses.
Right.
And it was a very tax-efficient portfolio.
Right.
So the tax losses at that time would have been very, very minimal. Now there still would have been inflation, which is unfortunate, but the point is that even after inflation, you would have made money during the worst decade of the U.S. stock market using our more diversified portfolio.
Right.
And the important thing for me is this. This portfolio was developed precisely to deal with situations like the period from 1961 to 1981.
Right. Right.
So even though the methods didn't exist at that time, these methods were developed in response to what happened during that time period.
Right. And it could very well be likely with our huge deficits we have right now, our tax rates could be going up again.
Yes,
maybe
exactly.
not to the 60s level, but
yeah,
and inflation could be going up too.
Yeah, exactly. And I think that it brings up the point that what real investors in the real world made, you have to take taxes and inflation and expenses into consideration.
Right.
I mean, it's nice to look at what they could have made if those things didn't happen, but that isn't the real world we all live in. And I think it was an excellent reminder for me, looking at this article and looking at this chart, of why we take all of those factors into consideration. And I want to emphasize this last point. It's an excellent reminder of how innovation happens. Back in 1961, what we offer to all of our clients, which can now be offered to anybody, no matter how much money they have, even the wealthiest person in the world couldn't have accessed it because it didn't exist.
That's right. That's exactly right. Yeah, and that's another reason, that just brings it to summation, Lauren, that's a great point. Some of my clients way back when our firm evolved to Erickson Wealth Tax Management, they go, why would you do that? Well, this is one of the reasons, because we see the importance of the taxes on your wealth. And so I want to thank you for watching this current episode of Erickson TV. We'll see you next time.
Bye now. See you next time.